Okay, thank you, Ümit, for the introduction. My name is Schedelik. I'm from Goethe University in Frankfurt, together with my colleagues Andreas, Nölke, and Alexandre, Podestá, Gomes. I present our work on capital flows, commodities, and growth models in emerging economies. This is the outline of my talk today. First, I will briefly sketch the research gap and the contribution of our paper to the literature. I will then delve a bit into the contributions from development economics to this phenomenon of commodity-led growth. Thereafter, I will present some stylized features and descriptive statistical evidence of the global prevalence of this growth model. And thereafter, I will present stylized features of the joint effects of commodity cycles and capital flows to emerging economies and the effects on such a growth model. And the concluding section will highlight the main contributions of the paper. First, as a reminder for the audience, myself and my colleagues are predominantly political economists. So the idea of this workshop, I guess, is a conversation between the disciplines, and we are from the other side, so to speak. And we can be located roughly in the camp Bruno criticized yesterday. We are engaging in the literature of the growth model perspectives initiated by Ucho Bacaro and Jonas Fondersen, and which is proliferating in comparative political economy quite for some time now, and is becoming an emerging paradigm in this literature. And although some of the criticisms raised yesterday are valid, we would say, nevertheless, we argue, and that's why our paper is also somehow located in this tradition. We think that they indeed made some seminal contributions to the field, because they highlighted several major conceptual issues that were neglected before in the discipline, that was pretty much dominated by the institutional focus on the institutional structures of capitalist economies, on supply side issues, pretty much dominated by the varieties of capitalism framework. And the main conceptual innovations, so to speak, although of course that they have been around before once, but they presented it in a more innovative way and put it them straightforward into the discussion, which was a refocus on macroeconomics and aggregate demand, which is of course for heterodox economists nothing new under the sun, but for CPE scholars it was something of a reinvention. And then another issue was the refocus on politics and the notion of social blocks, which we saw yesterday in Ümik's presentations, is quite an interesting and innovative concept, and is fruitfully applied in several studies right now. And the third point, which in this area we are locating our paper right now, is the international interdependencies of growth models. This was first and foremost applied empirically in explaining the great financial crisis regarding debt-led and export-led growth models, and also as in especially in the literature on the Eurozone crisis. And drawing on our earlier work, and also in line with several other scholars such as Eckhard Hein, Ümit Akçay, Benjamin Newman, and also recently Engelbert Stockhammer, more conceptually, we try to apply and extend this perspective, call it growth models of growth regimes, to emerging economies. And so far we have this endeavor have mapped several growth models in the global south, but now with this paper, and we would argue there's still a neglect of system level IPE variables, and in this line we also want to engage more thoroughly and more systematically with the literature in IPE, thereby connecting not only CPE with the heterodox post-Keynesian economics, but also with international political economy scholarship. And in this broader literature, there is a vibrant field of study focusing on dependent financialization, empirically analyzing debt-led growth in the global south. And there's also quite an interesting collaboration between post-Keynesian scholars and political economists. But we would argue that that's really worthwhile and very interesting studies, but they rarely neglect the elephant in the room, which we would argue in the case of developing and emerging economies are commodity prices and commodity markets. There are individual contributions that highlight the importance of this variable for Latin American countries. And we want to go beyond these studies and globalize this perspective, so to speak, and take a broader global perspective on these issues. And therefore, we go into dialogue with development economics, which this field of study is preoccupied with these issues from its inception. And well, drawing on our earlier work, as I mentioned, which we presented, I think, last year or the year before in a similar workshop here in a virtual Berlin, so to speak. And we came up with a threefold typology of growth models, which we empirically derived from simple national accounts decomposition, exercise similar to that, put forward by Hein and others. And we went beyond the dual typology of consumption and export-led growth models usually applied by Bacaro et al. On advanced economies, but also this is somehow different from the regularly applied fourfold taxonomy of Hein and others. As you remember yesterday, domestic demand boom, domestic demand led, weekly export led, and export led mercantilist. And we have a third type, we identified a third type for these countries, the export led, investment led. And with several subtypes, which are crucial, we would argue, for the intricacies of these several subtypes are crucial for understanding growth prospects of these economies. And without going into detail in the several subtypes, for now, in this paper, we want to highlight the difference in the export-led type, because this is somehow hidden in the usual categorizations. We argue that it is crucial to distinguish between commodity-based export-led growth and manufacturing-based export-led growth. This would be mainly in the language of Hein et al., maybe the growth drivers exercises. And and this is basically our the topic of our talk today. We want to elaborate on features of this growth model and on the interplay with several system level variables and the pitfalls of such a growth model for emerging economies. So as I stated, there is an established literature that investigates this type of growth, and basically starting with and that's why also the title of our talk, Dependency Revisited. Of course, it goes back to the structuralist tradition. Dependency scholars most famously stated in the Friedrich-Singer thesis. These authors claimed that specialization in commodities would lead to declining terms of trade for commodity exporters vis-a-vis manufactured exporters due to two mechanisms. The one being the demand mechanism, that means lower income elasticities of demand for commodities than those for manufacturers, i.e. when people become richer, they will spend more on advanced manufacturing goods than on and less on food and staple goods, and therefore, relatively speaking, the prices of the latter will be depressed vis-a-vis the former. And via the supply mechanism, this refers to the labor markets in these economies, which are characterized by low unionization and an abundance of skilled labor, which translates into the fact that technological progress will not lead to rising real wages of the workers in these sectors, but to declining prices for consumers in advanced economies, because workers will be easily dismissed by the large pool of low-skilled laborers in these labor markets. So this is maybe one of the most controversial and hotly debated and also empirically researched phenomenon in this literature, and people have come up with several findings: declining commodity prices or slightly upward prices, depending on the starting period. More recent contributions have highlighted the cyclicity and volatility of these price movements, which is even more crucial for the prospects for growth in these economies, and have come up with the notion of commodity supercycle. And a further point I want to highlight in this literature is the phenomenon of Dutch disease. Maybe most of you are familiar with that. For the others, I just briefly point to the fact that this refers to the real appreciation of a currency due to capital inflows associated with commodity exports and revenues, and due to two effects. Basically, the spending effect, that is increased domestic income and spending, translates into higher prices and output in non-tradable sectors, thereby pushing prices and wages in the tradable sectors, and declining competitiveness of manufactured tradable sectors, and thereby deindustrialization, exacerbated by the resource movement effect. That means capital and labor moving into the booming commodity sectors, thereby also pushing prices up in the tradable manufacturing sector and leading to deindustrialization. We will take up on these issues later on. And for now, we want to turn to the empirical exercises, so descriptive empirics on commodity dependence. Thereby, we draw on data by UNCTAD, and UNCTAD defines commodity dependence as more than 60% share of commodities as a share of total merchandise exports, which is, of course, an arbitrary definition because, as I stated in the paper, it leaves out major commodity exporters such as South Africa with a slightly below 6% share. So the phenomenon actually would be more prevalent than presented here even, but nevertheless the 60% threshold extends to 191 countries in the world by now, and it has increased over time. Broken down by income levels as defined by the World Bank, we can see that especially low income economies are affected by this phenomenon, 90%, and also middle income countries, and to a lesser degree high income countries. Having in mind that under this category of the World Bank, major Middle Eastern energy exporters such as Saudi Arabia, Bahrain, and others are included. So taking the more common view of developed economies, here only 5 countries, Greece, New Zealand, Australia, Canada, and Iceland are part of that group. And that's just a brief empirical observation for the prevalence. And here we see mapped all the commodity dependent economies as of 2019 and the degree of commodity dependence. And here we see it's quite a established phenomenon, and some countries are over 70 or 80, even 90 to 100% dependent on commodity exports. And the other axis of the scatter plot shows the share of these commodity exports in overall GDP. And here we also see that depending on the size of the economy, of course, these commodity exports have a huge share in some countries' GDP. That's why we can easily speak of a commodity-led growth model. We did not engage in the GDP decomposition exercises at this point for this sample of this huge sample, but this is an approximation to show that we can identify such a growth model for sure. And this fact is exacerbated by the notion that for some countries, even the dependence is on rests on just a single export product or a handful of export products, as actually it's the majority, over 50%, depend on just a few export items. So we will now turn to the major variable affecting this growth model, which is of course the prices that are internationally set in global commodity markets of selected. And here we show the price movement, the long run real price movement of selected commodities in the major commodity classes, which are agricultural goods and metals and minerals and fuels. And here we see clearly the volatility aspect that is very pronounced in these price movements, overall volatility, and above that we can discern several major price cycles. The last one being starting from the early 2000s and lasting until the mid 2010s. This was driven by demand from China and India and their industrialization. And these are mainly, there is work on on the drivers of these price cycles, and mainly 50% of these price cycles are driven by macroeconomic demand, global macroeconomic demand, and the major export markets. But others are also supply driven, and here the key oil market plays a major role, which is also relevant for the co-movement of these several commodities, because energy is a key input for the production of metals and for the harvesting and raising of major agricultural goods due to fertilizers and other issues. So that's why we see a co-movement of these commodities. And here, just as also an approximation, we see the correlation of the co-movement of GDP growth of the commodity-dependent economies and the percentage change of the major commodity price indices. And so these are average figures. If we wanted to go into more detail in with regard to case studies, which due to time constraints we could not do for this presentation, but we will definitely do it for the paper later on. And there we see even more pronounced correlation between GDP growth and commodity price swings. And these effects, there are several effects in how far commodity prices affect growth or affect this particular growth model in these countries. And one, the direct effect is of course obvious, rising and declining export earnings, but there are at least two indirect effects. And one refers to pro-cyclical public finances. That is that, as I referred to before in the scatter plot, the commodity sectors are huge in most of these countries and are important, very important for GDP, and implying also, by implication, also for tax revenues and profits of the major state-owned enterprises in these sectors. And a commodity price boom thereby translates into rising revenue and rising profits of SOEs, and thereby rising government spending, consumption, and investment. Reversely, commodity price bust leads inevitably to declining tax revenues and contracting government spending, which might be upheld for a while by going into debt, but eventually government spending contracts, and thereby exacerbates the bust period, enlarges the boom period, and exacerbates the bust period. The second indirect effect is the traction of capital flows, FDI, as well as, but mainly portfolio investment, which, following ACUs, we dubbed the commodity finance nexus, and to which I will turn in a minute. Here we also see, as a first glance, a correlation between the commodity price indices and portfolio investment flows to commodity dependent economies. We clearly see the co-movement of upswings and downswings of these prices. And the mechanism behind this co-movement goes as follows. Just briefly, I will go into that. A commodity price boom basically leads to prospects of rising commodity earnings, export earnings, commodity revenues, and thereby affects the external financial position of these economies. Lending rates and risk will be reduced, and thereby almost inevitably will lead to a surge in capital inflows, at least in most cases. Capital inflows have an effect on spending and investment in these economies, but also an effect on the exchange rate, which will appreciate, thereby leading to ever more capital inflows. And as an effect, will lead to the Dutch disease phenomenon I sketched briefly in the literature review. Basically meaning due to the appreciated exchange rate, the tradable sector will lose competitiveness, and this will lead to declining output in this sector, and will even reinforce the specialization on commodities and on commodity-led growth, and thereby will reinforce this cycle. In the boom period, of course, everyone is happy with that, and spending will and this might lead to spending bubbles also in the non-tradable sector, usually in the housing markets. But eventually there will be a bust of prices, and then this mechanism works in reverse too. So the bust of commodity prices will result in a declining or negative effect on the external financial position of these economies, and thereby this will translate into lower capital inflows or even capital outflows, which has an effect on the exchange rate, which will depreciate. And so those sectors of the economy that went into debt in the preceding boom cycle, they will be tremendously negatively affected by this depreciation and by the capital outflows, which might lead to a debt crisis and a banking crisis, and this will even exacerbate and negatively affect the already taking place declining output in the commodity sector in the economy, and thereby exacerbate the bust period too. So basically, as I said, the case studies will have to wait for the article that will come out. But so far, we have sketched this the joint effect of these two variables and the mechanism behind that. And that's why I will jump to the conclusion. Our aim was to contribute to the extension of the growth model, growth regime perspective to developing and emerging economies. Thereby, we stress the importance to highlight the relevance of system-level IPE variables for growth model CPE analysis. And we stress the importance to focus on commodity-based export-led growth when applying this perspective to the global south. We presented stylized features and some preliminary empirical evidence of the global prevalence of this model. We pointed to the cyclicity and volatility of commodity prices and the direct and indirect effect on this growth model. And we highlighted the so-called commodity finance nexus and the interplay, meaning the interplay between commodity price, boom bust periods, capital flows, and commodity-led growth model. Thank you very much for your attention, and I'm looking forward to the discussion.
Thank you for